All right, good morning, everyone. I believe that. All right, I believe we can all hear me and we can all see me, so we are going live already. All right, so we are back on the continuation of our JAMB 2026 preparatory class and on accounts, all right, a preparatory class for financial accounting, a preparatory class for financial accounting. It's good to be here, and I believe that each of us we are also happy to be in the class today. All right, so let's go on a ride into the world of one of the most important topics in accounting. All right, one of the most important topics in accounting. You see, this topic that I want to talk about is called principles of double entry. All right, principles of double entry, principles of double entry. All right, and you know, principles of double entry now. I must tell you that there is nothing you can do as an accountant or even in accounting as an accounting student without the understanding of what of the principles of double entry. All right, it is the basis of everything we do in accounting. All right, don't forget that while we're talking about um, concept and convention, there was this particular concept that we talked about, and that was the what the duality concept or the dual aspect concept. All right, and I said it is a very, very important concept in the world of accounting, all right, because it tells us how transactions are in reality. All right, now transactions generally are what two way. What we are saying is that there is no transaction without a minimum of what? Without a minimum of two parties. All right. Any transaction that is going to take place must um, involve a minimum of two parties. Must involve a minimum of two parties. All right. So, and because double entry, because accounting actually needs to pay attention to the two aspects, all right, to all the aspects of transactions, which are two in this case, all right. That's what brought about what the principle of double entry. All right, that's what brought about the principle of double entry. All right. I don't know. You might want to go on a memory lane and try to think about the history of accounting generally. All right, the history of double entry, and then in so doing, you will be able to understand. This is generally going to even be like a revision because, of course, um, I'm sure that every one of us know that history that I want to talk about. Who is the person that actually started with double entry accounting? Now, you must know that, when you're talking about the historical development of accounting, you definitely know that accounting is most likely as old as man. All right, is most likely as old as man, which means that accounting has actually been going on since um forever. Why? Because now, not in this structured way, of course. This structured financial accounting, you notice that it started around the 14th century, right, when Italian merchants started using um, plus and minus and all of that to record transactions on a daily basis, right? But of course, as trade began to grow, accounting also began to grow because people had to record everything they were doing, right? So as people advanced in trade, as commerce advanced, as trade advanced, what also advanced? Financial accounting also advanced, right? As financial accounting advanced as well as trade advanced. So generally, you can say that financial accounting actually grew alongside with the growth of what? The growth of trade. Is that fine? Financial accounting grew with what? With trade. Right. So But generally, the reason for double entry principle is actually logical, all right, and it is logical in the sense that um, every transaction has two parties. Published a paper on double entry principle. All right, you see, you cannot forget Fra Luca Bartolomeo di Pacioli, or just Luca Pacioli. All right, everybody knows that. Right, and it was an Italian monk that wrote a treatise. All right, a treatise, just like an academic book. That's what a treatise is. It was an Italian monk, and he wrote that book in 1494. All right, and the name of the book, of course, was Summa de Arithmetica Geometrica Proportione et Proportionalita. All right, which was arithmetic, geometry, and proportion. So in that book, he actually devoted the chapter to what? To put forward the principles of double entry system. So it was in that book that double entry was first written in a structured manner. All right, and then after that, people began to what? People began to develop accounting. You begin to develop new accounting processes, but you notice that every accounting concept, convention, processes, policies that people have actually discovered or developed during those times have actually been based on the what? On the principles of double entry. They have been based on the principles of they have been based on the principles of double entry. All right. But before we go into the principles of double entry itself, um, now you must understand that the principles of double entry actually only affect the ledger. All right. So we'll just talk about um, some uh, documents, some documentations before we enter into ledgers. All right. Now you can see my next slide. At the end of the session, we should be able to identify various source documents and their uses. All right. So even as we are talking about principles of double entry, we cannot talk about principles of double entry without examining certain documentation. We have to examine source documents. We have to be able to identify various source documents and know their uses. All right. You also have to be able to identify book entry and relate them to each other. All right. You must be able to know what source document rather is related to a particular what? A particular book, a particular book of original entry. All right. You also, and then we'll go on to explain and apply the rules of double entry. All right. So just sit back and let us enjoy the class together. It's actually nothing hard. All right. It's nothing difficult. So source document. Source document. Now, what are source documents? What are source documents? Whether you like it or not, I am sure that whether you like it or not, I'm actually sure that you have an understanding of um double entry, what source documents are, however little it might be. All right. So now we want to do what? We want to expand it further. Just give an explanation on it and make you see what source documents actually are. All right. What source documents actually what are. All right. Now, when you hear source document, look at two words. Look at the two words that make up source document. We have source and then we have document. So it basically means that now when you think about source, what does that mean? It means where something starts from. All right, the source of something. So when you see source, it means where something flows from. All right, and when you see document, you know what the document is. All right, so source document is that document. So literally, source document is that document that serves as the source of all transactions in a particular organization. It is what? It is the source of accounting. It is the source of the accounting process. Right? When we're doing the introductory class to accounting, we mentioned that accounting is the process of what? recording, analyzing, classifying, summarizing, and what? Interpreting financial information and communicating them to the users of what? Of financial statements. All right. Now, source document is actually what? The beginning of the accounting process, the beginning of the bookkeeping process. All right. Is the beginning of the bookkeeping process. All right. So that's generally what source documents are. So if you look at it, so source documents are written evidence of business transactions. Now, all transactions recorded must be backed or supported by what? By documentary documentary evidence, and this provides detailed information for the preparation of the books of accounts. All right. So now, when you are thinking about source documents, just think about source documents as evidential documents. All right, evidences of transactions. So source document. Now, don't forget. Now, for every transaction, we mentioned during when we were talking about concept and convention, I mentioned something that okay, when we're talking about concept and convention, sorry, ethics in accounting, and then we talked about the qualities of an accountant. All right. We also talked about the qualitative characteristics. All right. When we're talking about the qualitative characteristics of financial information, there was we talked about fundamental, and we also talked about enhancing. Now, under enhancing qualitative characteristics, we have verifiability, comparability, understandability, and timeliness. All right, in our previous lecture. Now, while under verifiability, I mentioned that a very important quality, of financial information must be what? Must be that it must be verifiable. It must be what? Verifiable, which means we must be able to trace it and be sure that this is what actually happened. All right. So if our financial statement is showing that we have assets of 500,000, there must be sufficient documentation to prove that we actually have what? Assets of 500,000. And I told you that these are the things that the auditor uses, all right, to do what? These are the things that the auditor uses to verify that a transaction actually took place. Is that fine? So source documents are those written evidence. They are those documents that serve as the evidence of transactions. Without source documents, nobody would believe you that a transaction actually happened. All right, because they are documents that are written at the point when transactions are carried out. All right, and without that, nobody will actually believe that a transaction took place. It is the evidence that a transaction took place at all. All right, so source documents are what? They are written evidence of business transactions. Without them, we cannot believe. All right, there is no other evidence of what? That a transaction took place. Now, an example of source document is a receipt. All right, so now let's assume that I sent money to you. My bank will send me a receipt. They will issue a receipt to me, and they will also issue a receipt to you. Now, you cannot deny that I did not send you money. Why? Because I have a receipt that was generated by my bank to show that I actually did it. I actually sent you money. So that's an example of source document. It is an evidence that the transaction actually did what? Actually took place. So for verifiability purposes, all transactions must be backed up by documentary evidence, not just oral evidence. They must be backed by what? By documents, which means we in accounting we don't take your word for it. We are sorry, but we don't take your word for it. There must be a written documentation to prove that this thing actually happened. All right, and that written documentation that proves that the transaction takes place is what is called source document. It's called what? The source document. It provides the detailed information, and it is from it that other books of accounts are developed. It is from it that what? Other books of accounts are developed. All right. So that's for the source documents. Now, what do you think are the importance of source documents? based on what I've said, or functions of such document. You know that the most important function of such document is that it serves as evidence of what? Of financial transactions. And by so doing, it guards against fraud and it makes what? Audit possible. You remember what I said about audit now? I said the auditor comes as an independent examiner of your books, right, to ensure, to check if everything you said is correct, to check the truth and fairness of your what? Of your financial statement. So source documents does what? It serves as evidence of financial transactions. Because of course, the two parties to the transactions have to sign on it, and so therefore they are difficult to deny. Do you understand that? And it is of course almost impossible to alter them in order to defraud somebody. For example, it is difficult to actually fake a source document to prove that you paid cash to an organization, because they will enter it in a receipt, all right? And without that receipt, they would nobody without that receipt, there is no evidence of what? Of transaction, there is no evidence of payment, right? So your receipt in that case, the receipt that is issued to you is what? Is your evidence of payment. All right. So the major function of source document is that what? It serves as evidence of financial transactions. So this next one is it guards against fraud and makes what? Audit possible. All right. Another one is it helps in efficient bank reconciliations. So because as at the time when you want to reconcile financial statement and also reconcile bank, you need your source document. For example, you need your bank statement, you need your receipt and all of that. All right. So that you can be able to do what? Reconcile documents. Is that fine? All right. Now, so the source document are as follows. Now we have various types of source documents. We have invoice, we have receipt, we have credit note, we have debit note, we have petty cash voucher, we have what? The statement of account. All right. There are also some that we are not going to really explain. Some other. So when you are asked like examples of source documents, you even have quotations, all right? You have invoices, you have credit notes, debit notes, you have payment vouchers generally, all right? You have payment vouchers, you have paying slips, all right? You have check counterfoils, you have receipts, you have pay slips, you have bank statements, you have billing cards, you have purchase orders, delivery notes, goods received note, all right? But there are some that are actually very important and they make recording possible in what? In the books of original entry. Now, before I go further, now let me tell you that there is a process to bookkeeping, because we said accounting is a process. All right, there is a process to accounting. Now, this is the way it moves. You record transactions first, but transactions are actually evidenced and documented first in the source document. So this is the way it moves. You move from the source document, number one, to the books of original entry, that's number two, to where? From books of original entry to the ledgers, from the ledgers to the trial balance, and then from the trial balance to the other financial statements, such as your statement of profit or loss, that's your trading profit or loss account, and your balance sheet. All right. So in our next lecture, when we talk about ledgers, all right, when we talk about ledgers and correction of errors, we are going to deal with that. All right. So we have invoices, we have receipt, debit notes, credit notes, and all others. All right. Now let's talk about invoice. Now, the invoice is a document that shows the full details of goods. Sent by the supplier to the buyer, stating the quantity, price, discount to be given, and what? And method of payment. All right. The invoice is what? It is a document that shows the full details of goods sent by the supplier to the buyer, stating the quantity, the price, the discount to be given, and what? And the method of payment. So inside the invoice, you have certain details. All right, the details that are shown, it is inside your invoice. Now, for example, if you approach a standard entity to buy certain items, all right, to buy goods, all right, you are supposed to be issued what? An invoice. All right, you are supposed to be issued an invoice. Now, invoice is mostly used in larger organizations, all right, because it's larger organizations that actually sell goods in bulk and also sell goods on credit. Because generally, if not, if you sell goods in cash, you would many people just use a receipt instead. All right. So most times what you get when you go and buy something is what is called a receipt. Why? Because you are buying in cash. But mostly in larger organizations, in the larger business world, most people don't buy in cash, they buy on credit. All right. Your supplier sells goods, the supplier sells goods on credit or sells certain goods on credit. Or even if they don't sell it on credit, they actually have to issue an invoice first before payment is made. Because, and why is that? It is because even the buyers have to inspect the goods and ensure that it meets their specifications before they will what? Before they will make payment. So to when goods are supplied, what accompanies is what? An invoice. It is inside that invoice that you see what? The details of all details relating to the goods that you bought. All right. So it is the supplier. Don't forget, it is the supplier that does what? That issues an invoice to the buyer, which means the seller issues invoice to the buyer. Do we understand that? The seller does what? Issues invoice to the buyer. Now that invoice shows the full details of goods that was sent. So, and those details are what? The quantity of the goods. For example, the invoice is going to show that 50 bags of rice was sold. It is going to show at what price. So, and it's going to be show. It is going to also show if any discount was given and the method of payment. That is, if payment is to be made. Now, if payment is not made currently, then you have to tell us that transaction was made on credit. And if you know when payment is going to be made, you actually have to say and also mention it as part of the details that right. You also have to mention it as part of the information, all right, contained rather in the invoice. All right, so the invoice is just that document that shows the full details of goods sent by supplier to the buyer, stating quantity, price, discount to be given, and method of payment. All right. There's a place I'm also going to explain how invoice works in terms of perspective. All right. So I'm going to there's a slide for that as we go further into this lecture. All right. Now the second type of source document is what? Receipt. All right. Receipt. As you can see on the slide, receipt. Now this document is known as evidence of payment. Just as the name implies, receipt. It is an evidence that you received cash. Now, we said source document are written evidence of business transaction. Now, what type of business transaction is an invoice showing? An invoice is the evidence of a sale, of the movement of goods. Let's put it that way. The invoice is the evidence of what? Of the movement of goods, which might be a sale or a purchase. All right, because when you sell goods, you issue invoice because now you are the supplier. But when you buy goods, you receive invoice from the supplier. Do you understand that? So you can have received invoice and issued invoice. Now that received invoice to you is what? Purchase invoice. But the invoice that you issue, don't forget, invoice is always issued by the supplier or the seller. They are the same thing. It's always issued by what? By the seller. Invoice is always issued by the seller. Right. So when you sell goods and you issue invoice, that's called what? A sales invoice. That is called a sales invoice. But when you buy goods and you receive a invoice or an invoice, that is called what? That is called a purchase. That is called purchases invoice. Is that understood? That is called purchases invoice. All right. So the invoice is the evidence of what? Of a sale transaction, of the movement of goods, of the purchase of goods. All right. While so now let's move on to receipt. The receipt is what? It is an evidence of payment. Invoice shows that a transaction took place. All right. But receipt shows that what? That there was movement of money. Is that understood? So the receipt is known as what? As an evidence of payment. It is sent by the seller to the buyer for confirmation of money received. Receipt is used for auditing purposes. It shows the date of payment. Now, you must understand that all such documents are used for what? Audit purposes. They have audit use. All right, all such documents are used for audit purposes. Now we said such documents are evidence of transaction. Now, so the question is, when I talk about a particular transaction, source document, the question that we want to answer is that what transaction does this evidence, or what type of transaction is this an evidence of? Is this source document an evidence of? All right, the receipt is an evidence of what? Of payment. Just as the name implies, it shows that you have received cash from somebody, you have received money, you have received payment. All right, so it is sent by the seller to the buyer for confirmation of money received. All right, so invoice can be sent for as a result of goods sold, but a receipt will not be sent until what? Until money is received. So in a standard organization, if somebody buys goods immediately, all right, you issue them an invoice to show that you have given them goods, and pays immediately rather. You issue them invoice, and then you also issue them receipt to show that what? You have received money. So a receipt is what? The confirmation of money received. So it shows the amount paid, and it shows what? The date of payment. So it is generally used when recording transaction. You know that we mentioned that source documents are actually generally used for what? Transactionary purposes. To record the transactions in your sales day books, in your books of original entry and in your ledgers. They are source documents is the first in line when you are recording your transactions. Right? It is what? The first in line when you are recording your transactions. So it is what? An evidence of payment, and it is sent by the seller to the buyer to confirm that money has been what? Has been received. All right. Now, what's the third one? Credit note. Credit note. You see, credit note and debit note, in my experience, it has been two of the most confusing, let me say, the most confusing source documents that I've ever come across. You see students saying, what's credit note again? What's debit note again? It is actually what? Very, very confusing. All right. Now, let's just take note of this. All right. Now, the credit note is a document sent by the seller. All right. I think, first of all, take note of this. The credit note is sent. Okay. The credit note and debit note are actually sent to request for a correction. Is that understood? So you actually have to first understand that credit note and debit note, they are issued or sent for what? For correction. So that you can correct what? A particular transaction that has taken place. All right. Now, the credit note is a document that is sent by the seller, all right, to the customer for reduction in the amount owed by him. Please pay attention to that. It is a document. Who sends this document? The seller. And he sends it to who? To the customer. So picture credit note like an invoice. All right. Invoice is always sent by the seller to the buyer. So also credit note is always sent by who? By the seller to the buyer. And the reason is that so that a correction can be made. And what correction wants to be made? A reduction in the amount owed by him. So when you think about credit note, you think about credit note as the documents that you have received or that you issue. But don't forget, it is always the seller or the supplier that issues the credit note. And the communication, or let me say, when a seller issues credit note, yeah, what is trying to pass, the information or communication is trying to pass across is that the amount you owe me has been reduced. I don't know if you understand that. Which means that if I owe, let's assume that you are the seller, I am the buyer. If maybe from transaction and goods that we have had together, goods that I've bought from you, I owe you 1 million naira. All right, you can send the credit note to me to tell me that my debt indebtedness has been reduced to say 900,000. Do you understand that? So it is a document sent by the seller to the customer for reduction in the amount owed by him, to tell the customer that the amount he has owed, or is owing rather, has been reduced by a particular amount. Do you understand that? Now, it majorly occurs because some goods are returned as damaged or not as ordered, which have been charged. Then it can be viewed in two different perspectives. All right, your credit note can be viewed in two different perspectives. So you understand what credit note is. The seller issues a credit note to the buyer to tell the buyer, to communicate to the buyer that the amount is owing has been reduced. And generally, it happens when goods are returned. You know what happens when goods are returned now. Now, for example, I buy goods from you, right, and then I discovered that some of them were not up to my specification, or they were damaged, or they were not what I ordered. You understand that trend now, what I ordered versus what I got. Now, in the corporate space, when you order something and it is not what you get, you can request for a refund, all right, or a reduction of your debt. Now, when you buy goods on credit, you have not paid for it, all right. Now you want to return. You notice that some of those goods are incorrect, abi? So what you do is what? You sell it, you return it back to the supplier. Now, as a result, the supplier issues a credit note. All right. He issues what? A credit note to you, to tell you that your money has now been reduced by the amount of what? By the amount of what's it called? By the amount of goods that you returned. All right. So say for example you bought goods worth 1,000. All right, you bought goods worth 1,000 naira, abi now, but you notice that 100 naira worth of those goods are not what you requested. It means that these goods are too much. Sorry, now you have returned 100 naira worth. All right, this is goods that you bought. All right, why you return this? It means that your indebtedness has now been reduced to what? Your indebtedness has been reduced to 900 naira. All right. Now, in that case, to show that your indebtedness has been reduced, the seller sends a credit note to tell you that he has removed 100 naira from your total indebtedness of 1,000. So now your net indebtedness is now what? 900 naira. Is that understood? Right. So that is how a credit note works. Right. It is given as a result of what? When goods are returned and the amount that that the customer owes has now been reduced. All right, so please don't forget that. All right, just take this off. All right, now I said credit note can actually be viewed from two perspectives. All right, your credit note can be viewed from two perspectives. Now we have credit note received from suppliers and credit note issued to customers. All right, now you can be a customer or a supplier. Now you know that it is the supplier that always issues credit note. Now when the supplier issues credit note, from the point of view of the supplier that is issuing the credit note, that's the second one. So the perspective is what? Credit note issued to customer, that's the first one. This will be entered into the return inwards book and the customer's account will be credited. I hope you understand that, because we said credit note is issued because your customers returned goods to you. Now, because goods are being returned to you, that's what? Returns inwards. So the book of original entry that we enter into will be what? Your return inwards day book. And the double entry will now be what? Debit return inwards day book. And since your customer's account is reducing, you have to what? You have to credit it. So you debit returns inwards day book and you credit your customer's account. You can see that we have entered a little bit into what? Into principles, into double entry. Do we understand that? Now, but when you receive credit note from suppliers, now don't forget, before you receive credit notes from suppliers, it means that you have returned goods. All right, so to you, from your own perspective, you are returning goods. You already returned goods outside, so that's what? Returns outwards. So you enter it into return outwards day book. All right, so it will be debited into the supplier's account but credited to your returns outward account. Do you understand that? So credit note received from suppliers shows that there is a return outward, that you are returning goods outside. But credit note issued means that you have returned, that there is returned inwards. All right. So now let's move to debit note. This is the document sent by the seller to correct an undercharge or when goods are not charged to the invoice. All right, so the way debit note works, so still pay attention, it is still the supplier that sends what? Debit note. All right, but the major difference between credit note and debit note is that credit note is used to correct an overcharge. Please pay attention to that. Credit note is used to correct an overcharge, while debit note is used to correct an undercharge. All right, so credit note corrects undercharge. All right, while your credit note corrects overcharge, that is when your money is too much, for example. All right, so that's the major difference between the two. One corrects an undercharge while the other corrects overcharge. So the way debit notes can work is, if for example, sorry, let me just take this off. All right, so when debit notes works is whenever there is an undercharge means that I have charged you lesser than what I should have charged you. For example, if you bought goods worth 500,000 from a customer, but from a supplier, but they mistakenly, maybe because they did not include all of the goods that they transfer to you. They do not include everything in the invoice, for example. All right, anything that makes the amount of goods, like sorry, the amount of goods that you bought greater than the amount that they asked you to pay. That's what an undercharge. It means that they have charged you less for what you actually bought. Do you understand that? That's an undercharge. So what they do is they send a debit note to tell you that there is an undercharge so that they can what? Correct it. So it means that a debit note actually what? Increases your liability as a customer, while the credit note reduces your liability. Debit note increases your liability as a customer. It increases your debt, while credit note reduces your debt. All right, that's the way credit note and debit note works. All right, now let's talk about the petty cash voucher. Now, this is a document which covers small payment for expenses credited to the petty cash book. Of course, you guys remember the petty cash book, abi? It is the cash book where you record day-to-day transactions, very little transactions, all right, day-to-day transactions. So there is something called the petty cash voucher. Before we talk about the petty cash voucher, you should know that whenever you see voucher in account, a voucher is an authorization for payment, all right? So a payment voucher is a document that is written to authorize somebody to make a particular payment. All right. So a petty cash voucher is that authorization for payment. So it is, but it is used for little payment, small expenses, right, such as little transportation costs here and there. All right, that cannot really enter into the overall account. So it goes into the petty cash book. Is that fine? So a petty cash book is a document which covers small payments for what? For expenses, and it is what? Credited to the petty it's credited to the petty cash book. All right, so now let's talk about the statement of account. The statement of account. Now, this is a document sent by the seller, don't forget, to the buyer at regular intervals, showing all transactions debited and credited and the balance due. All right. Now, in a standard organization, what happens is that when somebody buys goods, they prepare a statement for that person to show the amount, the indebtedness of that person at every point in time. So what you do is you always send that statement of account. Maybe at the end of every month, you send it to the customer so that the customer knows his debt. Do you understand? So the statement of account shows the goods that that person have bought, the transactions that have happened. So for statement of account, you can have a table. You can have something like this. You can have something like this. When the person buys goods, say the person bought goods of 10 naira, all right, you can write it here. When the person pays 1 naira, you write that the person has paid 1 naira. Then the balance will be here. That's 9 naira. So as at that particular day, you have what? 9 naira. So when you send this document to the buyer, all right, he sees that the amount he has to pay you is what? Is 9 naira. So and so on and so on and so on. So if I buy another goods wardrobe and I do not pay anything, this has increased to what? 12 plus 9. It has increased to 21. All right. So and so on and so on and so on, and then it increases like that. So that's generally the way what? The way the statement of account was. So it's just a document sent by the seller to the buyer at regular intervals, probably per month, to show all transactions that has occurred between the seller and the buyer. All right, debited and credited. Then you now show the balance due. That's actually the major reason for showing the statement of account. All right, you want to avoid any dispute, all right, so that the supplier can know, the buyer can know every transaction that has happened within that particular period and the amount that he still needs to pay, all right, to the buyer, to the supplier. So that's that for source document. Now let's move to another part. Let's move to books of original entry. Books of original entry. Now don't forget that the second aspect of this session is that we must be able to relate source document to what? To books of original entry before we now talk about what the application of the principle of double entry. Now, what are books of original entry? Now, books of original entry are also referred to as books of prime entry or subsidiary books or day books or journals. All right. So generally, you can books of original entry are still can also be called books of prime entry. They can also be called subsidiary books. They can also be called day books. They can also be called journals. All right. So when you see books of prime entry, please note that we are still talking about books of original entry. Whenever you see a question with subsidiary books, know that they are still asking you about what? Books of original entry. When you see day books, all right, know that we are still asking about what? Books of original entry. When you see journals, all right, you are still asking about books of original entry. Now, books of original entry are those books in which transactions are first recorded before being posted to the ledger. All right. Now, it is from books of original entry that recording actually starts. Source document is just what? A documentation. It's not like you are recording the transaction. You are just what? You are documenting transactions as they happen. As a transaction is happening, you are documenting it. You are preparing an evidence. All right. Now, you are preparing an evidence. You are preparing a paper trail. All right. A trail means something that can be traced. All right. It means a trace. All right. So that I can trace how a transaction moved from whenever it happened to the financial statement. For example, if I'm seeing a transaction in the financial statement now, I must be able to understand how it moved from wherever it moved from to what? To the financial statement. All right. So books of original entry is the first place where you record the transaction before you post it to the ledgers at all. All right. So it's part of the recording process. So transactions move from source document to what? To the books of original entry. To the books of original entry. Now, the books of original entry are as follows. We have the sales day book, we have the purchases day book, we have the cash book, we have the sales return day book. Another name for the sales return day book is what? Return inwards day book. Another name for the purchases return is what? Returns outwards day book. Then we also have the journal proper or general journal. Then we have the petty cash book. All right, we have the petty cash book. All right. Now, let me tell you before I start explaining everything. Let me give you one fun fact. All right. The fun fact is that, please, I need you to take note of this. It is actually very, very important for your exam preparation and also for further studies. All right. Your cash book is both a subsidiary book and a ledger. Because I know that you might probably know it's either you know cash book as a subsidiary book or you knew it as a ledger, or you have always been confused about where to actually classify cash book is as under rather. You must know that cash book serves two functions. It is both a subsidiary book, that is a book of original entry, and what? And a ledger. So cash book is a book of original entry. It is also a ledger. I hope that is understood. All right. So let's start. Sales day book. Now, what's our sales day book? So sales day book is just a book of original entry where credit sales are entered. All right. So it is the place where um when you sell goods on credit, the place you enter it into is what? We said the books of original entry are books where transactions are entered first, all right, before they are taken where? Before they are being posted, before they are posted to the ledger. All right. Now, when a credit transaction happens, when you sell goods on credit, before you take it to the sales account, which is the ledger, you have to record it where? The um sales day book. All right, the sales day book. I hope you understand that. So it is a book of original entry that does what? That records credit sales. It is the book of original entry that what? That records credit sales. And what's the relevant source document? All right, I've prepared a table here where we would see the source document and their books of original entry. All right, how source document relates to books of original entry. All right, how you can trace them to each other. So when you say a transaction is subsidiary book, you know that it is from this particular source document. All right, it is a question that can be asked. All right, so this is the summary, but I'm also going to talk about it here. All right, so the relevant source document is what? Is the sales invoice that is issued to the customer. But don't forget that the sales invoice has been issued to the customer, which means you actually do not have it. All right, which means that you actually do not have it. All right, but it basically means that now generally when an invoice is written, there's always a duplicate. All right, if you have ever been to a store to buy something and they issue a receipt to you, once they write it, there is another one under that, where everything they are writing on the one they want to issue to you is automatically duplicated. All right, so the relevant source document for the sales day book is the duplicate of the invoice that is issued to the customer. All right, so the sales day book will contain every information that you see on the invoice. All right, so you see a list of the sales invoice that has been issued in the order in which they are issued. All right, you see the date of the issue, you see the name of the customer, you see the number of the invoice, you see the sales ledger um, number to which the individual account will be posted. All right, and you see the net amount. All right, because the sales day book will also include what? The amount of invoice. All right, will include amount of invoice that was actually given to a particular customer. So generally, the sales day book is used for what? To record credit sales, to record credit um, sales. So when there's credit sales, you take it where? To the sales day book. Now the next one is what? Purchases day book. The purchases day book is actually similar to the sales day book, just that it does not record credit sales. Instead, it records what? Credit purchases. It records what? Credit purchases. Now, the relevant source document will be what? Received invoices. Purchases invoices that were received. All right. Because purchases invoices that were what? That were received. Is that fine? So it will contain the same details as the sales day book. For example, the date of issue, the date of the transaction, the volume of the transaction, if there were any discount received, and all of that, and then the account to which it was, the ledger to which it was what, to which it was sent, all right, or to which it was transferred, all right, as the case may be. So that's for purchases day book, all right. Then the next one is what? The next one is the what? The cash book. All right. The next one is the um cash book. I, Originally, I really do not have to say much on cash book because you know what cash book is. All right. But just as the name implies, it means the book of original entry where cash payments and receipts are what? Are recorded. So whenever a transaction happens in cash or whenever there is movement of cash, it has to show where? In the cash book. Don't forget, the sales day book records credit sales, purchase day book records credit purchases, but the cash book records what? Movement of cash, whether it is payment of cash or what? Or receipt of cash. Now, when we say cash in accounting, we are saying that the person paid. It does not necessarily have to be what? Like when we use cash sometimes as a general um means of saying that somebody has paid. For example, when I say cash sales and credit sales, cash sales might not necessarily mean that the person paid me physical cash, or that the person could have paid via bank. All right, it just means that the person has paid. So the cash book shows what? That's why there is cash book. There is only cash book. There's no cash book and bank book. It's now under the cash book that you have your your bank column and your cash column. All right. So the cash book means that there is movement of money, whether by transfer, by online payment, by bank payment, by check payment, or by cash. All right. So the cash book is an evidence, or it is where cash payment and cash receipt are first recorded. All right. So he also tells, so that's where cash book comes in. Now the next one is what? Sales return day book. The sales return day book. All right. Now, as we mentioned, another name for the sales return day book is what? Return inwards day book. Return inwards day book. Return inwards what? Return inwards day book. All right. And it is the subsidiary books in which goods returned to the entity are recorded. All right. So when you sell goods and the customer returns them back to you, or it might not be everything, it might be just a portion, you have to show them here in the sales return day book, otherwise called the returns inwards day book. The returns inwards day book. All right. Now, don't forget, let me go back to cash book a little. The relevant source document for cash book is what? Receipt. Whether receipts that were issued or receipts that were received. All right. Because receipt is an evidence of what? An evidence of payment. And whenever payment is made, it has to show in the what? It has to show in the cash book. All right. So then we also have the purchases return table. So, so we also have the purchases return day book. Another name for the purchases return day book is what? Returns outward day book. The returns outward day book. All right. So returns outward day book is the book of original entry where you record transactions whenever you return goods. All right. So if somebody sell goods to me, so generally, you know that the sales return day book is used by the seller, while the purchases return day book is used by the buyer. All right. So as a buyer, when I buy goods and I'm not really comfortable with the things that I bought, or or maybe they delivered something that I did not order, or they delivered over what I ordered. All right. I have to do what? I have to return it. So when I return it, I show the transaction that something has been returned. That it is shown where? In the purchases return day book, otherwise known as what? The returns outwards. So can you see that I'm returning out? So it is shown in the returns outward day book. If the return goes to me as the seller, it is being returned inward. Right? So that's the sales return day book, or what? Or the returns inwards day book. Now, we also have the petty cash book. The petty cash book is similar to the cash book. All right. It is just that it is a cash book for what? For petty transactions. Look at it, petty. If they say, why are you being petty? It means that why are you getting worked up on little things? All right. So when you talk about petty, it means little things. All right. So petty cash book is also a cash book, but it deals with little transactions, with small day-to-day expenses. All right. That does not really have a place in cash book, right? Because for example, it does not make sense for a large company, like a very big company, to be showing transactions such as we bought something worth 500 naira, we bought something worth 1,000 naira, 10,000 naira. All right. For a company that works around millions and billions. All right. So they have something called a petty cash book. All right, so that's that. Then we also have the journal proper, yeah, or the general. Okay, but don't forget the relevant source document of the petty cash book is going to be what? You remember the petty voucher, the petty cash voucher, the petty cash voucher. We said it is a document which covers small payments for expenses and it is credited to the petty cash book. All right. So now the journal proper or the general journal. All right. Any other transaction that cannot be entered into any of these underlisted sales day book is enter into what? Into the general journal. So if you have any transaction that does not fit that does not fit a transaction that can enter into the sales day book, the purchases day book, the cash book, the sales return day book, the purchases return day book, or and so on, has to be entered where? Into the general journal. An example of that is if you buy assets on credit. Now don't forget, the sales day book is not to record when you buy everything on credit. It is only used to when you sell everything on credit. Sales day book is used to sales day book and purchases day book. For example, sales day book is only used to record when you sell goods. I mean your normal goods on credit, not when you sell your asset, the asset of the business. Now, when you sell your asset of the business on credit, then it has to actually go into the general journal. So let's take the example of somebody selling bread, right? So or rice, right? Now, when he sells bags of rice on credit, it will go where? Into the sales day book. But if he wakes up and one day and decides to sell his truck, his delivery truck, that's not sale. All right, that's not a sale that occurs in his normal day-to-day transaction. So by so doing, it has to actually go into what? The general journal. It does not have a place in the sales table. Another use of the general journal is what? The general journal is also used to what? To correct errors. The general journal is what? Is used to correct errors. All right. So it's also used for opening and closing entries. It's also used for what? Transfer from one account to the other. Then it's used for what? End of period. Um, it's also used for end of period adjustment. All those accruals and prepayment and all of that. Then it is your journal is also used to record purchase of business when you buy, when another business, all right, when an organization acquires another organization, all right. So use your journals to do that, right? So, and one importance of journals, books of original entries generally, and even journals, is that they record transactions in more details. All right. Now, for example, your journals has a format. All right. You have a detail, you have the particulars, rather, you have the date, you have the particulars, you have the debit, you have the credit. Then after every transaction, when you say debit this and credit this, you include the narration to describe what has happened in that particular transaction. Is that fine? All right. So that's that on books of original entry. So now let's look through a summary of source documents and what? And books of original entry. All right. So how does source document relate? Now, don't forget I mentioned that transactions are recorded into the books of original entry from what? From where? From the source document. All right. Transactions moves from what? So I'm sorry. Transactions move from source document what? To the books of what? Of original entry. All right. So now let's do a quick summary of everything that we have discussed regarding that. Now, description of items. Source. I hope you can see the table. You have description of items, you have source document, and you have what? Subsidiary books. Description of items, source document, and what? And subsidiary book. So we are saying if a particular transaction happens and is entered into a particular source document, what will be the relevant subsidiary book? Now, the first one that we'll talk about. So we are going to be doing it like a question and answer kind of thing. Do you get that? All right. Which means I have the source document, the subsidiary book is there, then I will discuss the kind of item that would lead to that. Is that fine? All right. So description of item. Now, source document is sales invoice. I said the relevant subsidiary book for the sales invoice is what? Or let me start from the back, then we'll work it back. Now, the first subsidiary book here is sales day book. What's the relevant source document? That's what? The duplicate of the sales invoice. Now, what will be the description of item? Credit sales. All right, credit sales. Credit sales. It is credit sales that lead to what? That lead to sales day book, or that is recorded in sales day book. All right, so the next one is what? Purchases day book. All right, purchases day book. Any entry that will go into the purchases day book will come from where? From the purchases invoice. And what will be the description of transaction? Credit purchases. All right, credit purchases. Now let's go. Returns outwards day book. Don't forget, I mentioned that the returns outward day book is filled from your what? Credit note issued. Because when you issue credit note, it means that it means that goods have been what? Have been returned. All right, it means that what? Goods have been returned. All right. Yeah, sorry, you notice that there has been a mistake in this table, but the correct one is here. I made a mistake while preparing that. All right, but just pay attention. Return outwards. This one is return outwards instead of um it should not be returns outwards, it should be returns inward. So the relevant source document for returns inwards table, um let me correct that. So this is the way it works. All right, so let's just manage that. Apologies. So let's just manage that. So the relevant source document for returns inwards daybook is what? Credit note issued. So because when you issue credit note, it means that somebody has returned goods to you and now you want to correct the overcharge on their account. You want to tell them that because of the goods that they have returned, their indebtedness, their debt has now been reduced. For returns outward daybook, it is what? Credit note received. What will be the description for credit note issued? That will be goods returned. That's goods returns when you received goods. All right. Credit note received will be what? Goods returned outwards when you return goods outward. Now let's move to cash book. Cash book. Now don't forget that on your 2-column cash book, all right, we have on your 2-column cash book, all right, there is there are 2 columns. You have your cash column and your bank column. All right, now your bank column, cash column rather, for subsidiary book, the relevant receipt or the relevant source document will be what? Will be receipt. And that will be what? Cash payment or receipt. When you receive transactions or when transactions are done in cash, for example, you bought goods for cash, you sold goods for cash, you paid expenses in cash, and all of that. Now let's move to, but the bank column will be bank pay-in slips, all right? What you call your teller. When you go to the bank, those deposit slips, all right, your bank paying slips is called deposit slip, or your check counterfoils. All right, the check counterfoils is that if you have seen a check before, there is a little side. If you write a full check, if the check is written here, there is a smaller side of the check. It's called a counterfoil, where the major details on the face of the check are duplicated. All right, so the check counterfoil also serves as a source document for what? For the cash book under the bank column. Then, of course, for the petty cash book, as I explained earlier, is the what? Is the petty cash voucher. All right, now let's enter into the application of the principle of double entry. Now, before we even go into that, you understand what double entry is, Abi? We said double entry means what? It means that there are 2 accounts always involved in every transaction. There are 2 accounts, 2 people, 2 parties always involved in the transaction, and one account must be debited while the other account will be what? will be credited. So technically, and we say you debit what? The giver. Sorry, you debit the receiver and you credit what? The giver. Debit the receiver, credit the giver. All right. Now you can note this. The Officially, the principle of double entry, the double entry principle actually states that for every debit entry, there must be a corresponding credit entry and vice versa. All right, and vice versa. For every debit entry, which means that once you make a debit entry, there must be a corresponding credit entry. You must also make a what? Another credit entry. So for every debit entry, there must be a corresponding credit entry, while for every credit entry, there must be what? A corresponding debit entry. For every debit entry, there must be a corresponding credit entry. And for every credit entry, there must be a corresponding debit entry. All right. So that's basically what your principle of double entry is saying. It's saying that your in while doing accounting, you must always debit one account and credit the other account. And so far you have credited one account, you must also go and once you debit an account, you must look for the corresponding account to debit. All right. And it is not actually hard to come by. The first thing that you must know when you are doing double entries, you must be able to identify the two um, parties to the transaction. Now, once you are able to identify the two parties to the transaction, you are good. Is that fine? You must what? You must be able to sorry. You must be able to identify the two parties to what? To every transaction. And once you do that, you are what? You are good. All right. Now let's take this illustration, this simple example to just illustrate um the principle of double entry. Then we complete this table and then we end our class for today. And then in our subsequent classes, in our next class, we'll talk about the accounting equation, we'll talk about the ledgers and all other things. But let's just um, complete this. Illustration. Mr. Ojo started business with 40,000 naira in cash. The two accounts involved are what? Capital account and cash account. Now, this will now take you back to your understanding of concept and what? And convention. We said once somebody starts a business, the business entity concept applies, which means the business is separate from the owner. So if Mr. Ojo started business with 40,000 naira cash, who are the two parties to this transaction? Mr. Ojo and his business. All right. Mr. Ojo and his business. So Mr. Ojo is giving to his business. All right. Now, the two accounts that will now be involved are what? Because Mr. Ojo is starting business, the money used to start a business is called what? Capital. All right. So that's what? Capital account. Capital account. All right. Why the other account is what? Cash account. And why is that? It is because the money is what? In cash. Don't forget, capital can be in cash or kind. What does that mean? It means that um you can start your business with cash, and of course while starting your business you can also include something else that is not cash. For example, if I want to start a business, I can start Mr. Ojo can decide to start with 40,000 naira cash and also invest his personal truck. Let's assume that he had a truck that he just used for personal purposes. Now he wants to start using that truck for what? For business purposes. That truck is also part of his what? His capital. It is just in form of what? Truck. So in that point, in that case, you will know the two accounts will be what? Capital and truck account or asset account. But in this case, the two accounts involved are what? Capital account and cash account. Who is the receiver? Capital. All right, so you have to identify both receiver and what? And giver. So you debit one account and you credit what? The other account. Now let's continue. Sorry. So the class will end soon. We are almost done. We are almost done. Yeah, that's to Chisholm. The class ends soon. All right. So, please, there is a slight mistake here. The two accounts involved are capital account and cash account. But please kindly note that the receiver is actually not capital. All right. The receiver is cash, while the giver is capital. So let me try to rectify that. Uh, so this is incorrect. I hope you can see it. The receiver is cash, giver is what? Is capital. So you are crediting the giver while you are debiting the receiver. This is the correct treatment. All right. So please, there was a mistake there. You can just sorry. So just ignore this. So the receiver is what? The receiver is cash, while the giver is capital. Right? Please, if you don't understand that, you can drop a message on the comment section, and then I'm going to explain better. But let me just explain. Now, what it means is that now there are two people. Don't forget, I said you have to first identify the two parties to the transaction, and that's what. In this case, we have Mr. Odo, who is the owner of the business, and then we have what? The business himself, business entity concept. Business entity concept, Abi. You are seeing them as two. All right. Now, the cash is representing the business because cash is a business account. All right. But capital stands for who? For Mr. Ojo. Capital is, there is, since Mr. Ojo is the owner of the business, you cannot set up an account for him and say Mr. Ojo's account. So capital is the way you recognize the owner of the business. Is that fine? So since the owner of the business is the giver, you have to credit his account. So that's why you credit capital account. But cash is receiving because cash is going to increase. The business is receiving cash, so cash is receiving something. All right. So you have to what? Debit the receiver. That's cash. So you debit cash with 40,000 naira and you credit capital with 40,000 naira. Now the next one is cash for rent. When you pay cash for rent, cash is paid. Now cash is paying. So who is the giver here? Cash. Who is the receiver? Rent. So you debit rent account, but you credit what? Cash account with 450 naira. So now let's complete the table that we have below. So we'll just go through it briefly before we go to our quiz. And if our time does not permit us, we can work on our quiz in the next lecture. All right, but let's go through this table to understand the application of double entry principle better. So the first one, description of items debited and credited. So if you start business with 800 naira cash, what do you debit? Just as we mentioned here, right? You debit your cash because cash is the receiver and you credit capital. That's the same thing. Now, goods sold on credit to Mr. Ayo. Goods sold on credit to Mr. Ayo. Now, who is the receiver? And who is the receiver? Sorry, who is the giver and who is the receiver? Don't forget we are debiting the receiver and what? And crediting the giver. Now, the business is, there are two parties to this transaction. We say the business that is selling goods to what? Mr. Ayo. Mr. Ayo is what? Receiving goods, abi? Now, what we are doing is there is a sale. All right. So what you do is you debit Mr. Ayo's account and you credit what? And you credit sales account. All right. Debit what? Debit Mr. Ayo's account and credit sales account. You know Mr. Ayo is the receiver of the goods and sales is giving goods. All right. So you debit Mr. Ayo's account, you credit sales account. Now, goods bought by check. Goods bought by check. Now, when you buy goods by check, that's purchases, abi? All right. Now, in that sense, your bank is what? Your bank is giving money to buy goods. So the receiver here is purchases, while the giver here is what? Bank. So what do? Debit purchases account and credit what? Credit bank account. Debit purchases account and credit what? Bank account. Now the next one is sold goods for cash. Sold goods for cash. So when you sell goods for cash, who is the giver, who is the receiver? You are receiving what? Who is the giver, who is the receiver? Let me even confirm if people are. All right. So when you sell goods for cash, you do what? You are receiving cash. All right. So it means that cash is receiving. But who is giving the cash? How did we get the cash? From sales. So it's actually sales that is giving the business cash. All right. But cash is receiving. So you do what? You debit your cash book, your cash account, and you credit what? Sales. So debit cash, credit sales. Debit cash, credit sales. Debit cash and do what? And credit sales. Now, goods were returned to Olotu. Goods were returned to Olotu. Goods were returned to Olotu. Right. So if goods were returned to Olotu, who is the giver, who is the receiver? Now, don't forget we said that when we return goods, now goods were returned to Olotu. This is what returns outward. Don't forget when we were discussing credit notes. All right. We said when there is returns outward, then you have to what? You have to debit the supplier's account and what? And credit the returns outward account. You debit what? The supplier's account. You debit the supplier's account. You are returning goods. So is the receiver of the goods. All right. So Olotu is the receiver of the goods and is the supplier. All right. So what do? You debit Olotu's account, then you credit whose account? You credit the return inwards, the return outwards account. All right. The next one, bought a motor van by check. Bought a motor van by check. All right. When a motor van is bought, now we have two accounts. We have the motor van and we also have the bank account. Who is giving, who is receiving? When you buy a motor van by check, you debit your motor van account and you credit bank account. Why? Bank is giving money to motor van because you are buying a motor van. So bank is giving, so you credit bank. But motor van is receiving, all right? So you do what? You debit motor van. You debit motor van. All right, so that's it for the application of the principles of double entry. So in our next lecture, we are going to explain other rules, and then we are going to talk about ledgers, trial balance, correction of errors. All right, so let me see. With the time we have, we should still be able to go through the quiz, but um, I'll just go through the question so that you can pay attention to it in the video. This is the question one, so then you can answer it. All right. In our next lecture, we can now I'll give the answer to it. This is question two. This is question three. This is question four. So please practice it. This is question five, question six, and question seven. All right. So we have come to the end of today's lecture, and thank you so much for joining. And I wish you success. I wish you well in your preparations for your exams. Bye. See you in the next lecture. Yeah, you're welcome. You're welcome.